Well, honing in on some of the big players on the US market. For more, we are joined now by Nathan Bell from Peters McGregor. Nathan, thank you so much for being with us. Certainly, we are watching those FANG stocks, the likes of Facebook, Amazon, Netflix, Google. They've been really in the eye of the storm lately, certainly outperforming when we consider the negative start that they did have in the wake of the US election. Just tell us what you're watching.
Yeah, well, I think those four stocks are responsible for a lot of value investors underperforming for the last 3 or 4 years. They're just such large companies now. They're about $1.5 trillion in market value. So they tend to be the biggest companies in the biggest indexes, which is why I think passive investors have tended to give up on active value managers. But we've actually got a contrarian play in the sector, and that's Twitter. No one's interested in Twitter whatsoever. It's down by about a third since it listed 2 or 3 years ago. It's had about 4 CEOs over the last 10 years. It's now got its original CEO and founder, Jack Dorsey, in charge. Interestingly about Twitter, it doesn't actually have a revenue growth problem. What it has is a cost problem. Its revenues are actually growing quite quickly because of ads, just like Facebook. But its costs are going up just as quickly. I think what else people don't realise is just how much cash is sitting on the balance sheet of Twitter as well. So it's got a lot of financial flexibility. Dorsey's been cutting costs. And if we can get to margins that approach sort of 30 or 40% over the next 2 or 3 years, then this is a potential double for this stock. But it's just not the sort of stock that everyone's in love with at the moment because it's not an easy story. Management has a lot to do. It's not guaranteed. But the thing we like about this business is if management botches this opportunity again, then there is a great deal of cash on the balance sheet. And with a market cap of around $10 billion, which compares to the $1.5 trillion market values of the other 4 FANG stocks, we expect this company to be taken over at some point.
Just to throw it out there, I mean, naturally we all watch Mr. Trump's Twitter feed on a regular basis. Does this feed in at all in terms of the market valuations of the company?
Look, if anything, it just tells you that this is a really strong business. One of the ways you can get comfortable about buying a business is seeing it having gone through a bunch of different cycles. And if you, there's a book about Twitter, and if you have a look at the way it's been managed over the last 10 years, it's been absolutely atrocious. The costs from research and development have absolutely skyrocketed in the recent years. But if you're a user like Trump is, you'll have noticed that there's barely been any change to the website at all. So you wonder why all this, or what all this money has been wasted on. So if we can actually have management in there, doing the right things, cutting costs, and actually delivering a better service for users, we think there's a heap of value here. And the fact that this business hasn't folded, still has plenty of cash on the balance sheet, yet despite how badly it's been managed, tends to us there's a lot of resilience in this business.
We've been watching Verizon a lot over the last few weeks, certainly making headlines, particularly when it comes to that deal with Yahoo. Reportedly interested in buying Charter Communications. What's their interest in here, and how do you think that would in fact affect their portfolio? In fact, your portfolio, investors' portfolios.
So our largest position is some indirect holdings in Charter Communications. It's a business we really like. 18 months ago, it was in the Wall Street Journal every second day. Everyone was talking about how everyone's cutting the cable and it's going to lose cable subscribers and profits are going to end up in the toilet. Yet what people didn't realise, and what you've actually seen in the Wall Street Journal more recently, is that Charter Communications has a wonderful broadband business. Interestingly, about 3 or 4 years ago, the company actually stopped reporting the profit margins it makes on broadband. Because if you think about the cable business, you have to pay a lot of money away to content providers to provide the service, whereas with broadband, essentially all you have to do is plug people in, and the incremental dollar of revenue you get from someone is about 99% margin. So it's a tremendous business, and what we're going to see over the next 5 to 10 years is the telecommunications businesses and these cable businesses coming together. They offer some similar services in terms of the broadband and wireless communications, and we think eventually all these companies come together. It's just a matter of when, but maybe it's going to happen sooner rather than later.
Naturally, we're taking a look at some of the economic data that's coming out of the US, and certainly what this means for corporate opportunities there also. We're seeing home for sales in the US at or certainly near all-time lows, suggesting that more homes will need to be built sooner rather than later. Nathan, how are you positioned on that, or how should investors be positioned to benefit from this?
Yeah, at the moment we've got, as you said, almost record low homes for sale. We've also got housing starts, or the number of homes getting built each year in the US is currently running a bit over 1 million. The long-term average is about 1.5 million, which is down from 2 million pre-GFC. Obviously, we don't need 2 million a year, but it shows you that the market's getting tighter and tighter, and all that excess inventory that caused the GFC in Las Vegas and those sort of places in Florida is starting to get chewed up. Now, the way we're playing it is we own Wells Fargo, so if there's an increase in credit growth, that should be very good for the banks. Obviously, there's a lot fewer banks around these days than there is since the GFC. Despite everyone complaining about banks getting too big, they've actually got bigger. So there's only going to be a few banks that really benefit big time if we do see credit growth. But our more direct recent holding is a company called NVR. It's a home builder. Quite amazingly, it was the only home builder in the US that actually made a profit in 2009. And if you have a look at shareholder returns over the last 10 years, they're quite incredible. There's basically NVR making a really good return, and then everyone else basically not making any money at all, and some losing a lot of money. The secret sauce to this business is that rather than buying up huge land banks, it takes options. So it'll pay 10% for an option on a piece of land, and then it will only develop it in the future if it thinks it can make a profit on it. So it doesn't get stuck with this huge amount of debt on the balance sheet. And because of that, the company's been able to buy back about 75% of its shares on issue over the last 10 or 20 years. So it's a real cannibal when it comes to buying back its shares. You'll never see any interviews from the CEO. It doesn't do quarterly earnings. Everyone's just focused on making money, and that's our most recent holding, and one we expect to benefit hugely if we actually do see these millennials starting to move out of their parents' homes.
Just lastly, Nathan, before we lose you, I just wanted to get your take on the broader US earnings season, and certainly how you feel US corporates have performed overall, because it does seem to have been somewhat of a mixed bag.
Yeah, I think if you look at 12 months, 18 months ago, you saw particularly a lot of industrial companies, a lot of energy companies reporting really bad figures. So I think what you need to do is really look through the comparisons. You're going to see a lot of businesses, I think, over the next year report much higher figures than they have in the last 12 months, and it might make a lot of cyclical businesses actually look like growth stocks. But really, it says more about how bad the year was previously than how good things are at the moment. But we've still got very low interest rates. The US economy might not be growing as quickly as we'd all like, but it's doing okay. And I think the real missing link is the housing market. And if we might have a situation where this millennial population, which is the biggest in US history, if they see interest rates starting to go up, they might try and borrow the money now to buy a home before either homes get more expensive or their interest costs go higher. So that's a potential positive for the US economy that's not there currently.
Nathan Bell, we will have to leave it there. Thank you so much for your time.
Thanks, Natalie.